When we look at any ETF, we obviously want to see great growth over time. And when you stare at an ETF that is showing you 41% growth in 1 year, 117% growth in 5 years, and 290% growth in the last 10 years, you tend to perk up and want to dig in a little bit deeper. And that's exactly what we're doing today in this video. We're going to be looking at the ETF known as SCHG, and that is Schwab's US Large Cap Growth ETF. Could this be an ETF that you could add to your financial independence portfolio? We're about to find out. Now, if you hung around the ETF world in any period of time, you may be familiar with these high growth ETFs, such as VUG, you got Triple Q, VGT, ABCD. That last one, that was a joke. But is SCHG just another noisy ETF in the world of all these growth ETFs, or does it offer a little bit more? Well, let's talk basics first, and then we'll have fun with the money performance that we always talk about with these ETFs. This fund, it was developed in late 2009. Now, how interesting is that? We're in the midst of the Great Recession back then that started in 2008 and lasted right until the beginning of 2010, give or take. And, here comes out this high growth ETF. That's actually a great time to launch, I guess, because everything's down. But they launched in December 2009. And if we look back at the 1, 3, 5, and 10-year total return, now remember, total return includes any dividends that are paid out, we can see that return performance compared to the S&P 500 to actually be outperforming. Now you can see this one's really kicking well in comparison. The other benefit to this is the expense ratio, coming in at only 0.04%, making it cheaper than that natty ice that you bought last week. You know who you are. And when we look at holdings of a particular ETF, it's really interesting to dig into this. And that is the individual stocks that the ETF invests in. So you can see we're very technology heavy. See, the thing with that is technology right now is leading the way in the market. It's what's really making the stock market and the overall GDP of America so strong. But I bet if there's an industry sector that emerges someday called artificial intelligence, that would maybe be the next big thing to watch out for. See, right now AI is tucked under technology, but wouldn't it be interesting if that becomes its own sector someday? Then what we see is AI, technology, financials, consumer cyclical, all that stuff. This could easily be the next emergence. This could easily be the next emerging sector to keep our eye on. But in the meantime, the beauty is technology is what's holding up the market. And as long as you have faith in the continuing development, growth, and excitement of America and the world as a whole, that's what can really help your portfolio over time. So no surprise that the top holdings as of 2024 include things like Microsoft, Apple, Nvidia, Amazon, Meta, and a powerhouse of growth companies throughout. Now, oftentimes on this channel, we talk about Triple Q. That's Invesco's high growth fund. But that one tracks the NASDAQ 100. See, the big difference between these two, QQQ and SCHG, is that SCHG, you're going to get a little bit more exposure to sectors such as financials than you would with Triple Q. Now, for dividend-seeking investors, this one may not be your jam because it has a relatively low dividend yield of 0.45%. But that reflects its overall focus on growth stocks after all. Remember, growth stocks are those companies that are going to reinvest their profits, reinvest their capital so they can continue to emerge, innovate, and grow. But the benefit of that is your stock price would go up over time. So you're going to realize some beautiful capital gains. I mean, you saw the numbers earlier. We're talking a significant capital gain. And because they're reinvesting those profits back into future innovation, they're not paying as much as far as dividends are concerned. But don't forget, you can always balance your portfolio with Schwab's dividend fund, SCHD. By the way, I don't know about you, but do you ever refer to SCHD as SHID? Like SHID? And this one today is SHIG. Yeah, SHIG. I wonder if I could get away with that, if you guys would understand what I'm saying. But hey, Schwab, don't come out with like a technology-only fund, because you'd had to call it something like SCHT, and then I'd had to call it something like So let's chart this against some of its peers, the S&P 500, and the 3-fund portfolio that I talked about in the earlier videos. Now, with Seeking Alpha, you can always go to charting here and plug in whatever you want. Get yourself a good discount, link down in the description below, and you can follow along with me if you want to. So one thing I like to start off with is let's go to metrics, get rid of this price return. Don't really care about that. I actually care about the overall total return, because we want to look at dividends reinvested. Yeah, I know 0.45% isn't a lot for a dividend paying stock, and that's not what this is anyway. But I'm going to be comparing it to some, and it's always good to look at that total return to get the full glimpse of your portfolio. So if we look here at the one compared to the S&P 500, the 1 year, look at the difference. I mean, we're talking about 25% on the S&P 500 versus 42%. Wow. Let's compare it to some of its peers. We're going to hit select symbols, and we'll do VUG, which is Vanguard's fund, and QQQ, which is Invesco's fund. Let's go ahead and update the chart and see how we're doing here. Now, in the 1 year, you can see SCHD at 42, VUG at 37, underperforming, and you can see QQQ is actually underperforming SCHD. How interesting is that? I mean, I'm a big fan of QQQ. I really am, but this is like one of the rare times that I look at a charting and QQQ is not like well above and beyond. Typically, that's what I always see. QQQ always likes to like moon, and not the case here. Interesting. But let's take a look at the zoom out, because it's always important to zoom out. Let's go to the 3 year. Okay, now we're actually still looking favorable for SCHD at 30% return compared to 23% on VUG, 28% on QQQ. The 5 year is where things get interesting. Now that's where our buddy QQQ moons. And that's typical because, again, it's more heavily focused on technology and a little bit on financials, whereas you're going to have a little bit more of a bigger factor in SCHD on financials, less than technology. So you can see here 123 versus QQQ's 133. VUG underperforming? No. Very interesting. And then we'll go to the 10 year. I can't go to max because some of these funds did not exist for as long as the other ones. But if we do go to the 10 year, now you can really see an interesting trend here where QQQ is leading the way, followed by SCHG, followed by VUG, and then followed by the S&P 500. So this could be a very good thing to add to your portfolio if it is in line and if it meets with your overall performance goals of your particular portfolio. I can't give you financial advice. You got to know what works best for your goals. But what about the 3 fund portfolio that I often talk about? Well, QQQ is part of that. So we'll erase VUG. I'm going to erase the S&P 500 for this next one. And then let's plug in VTI, which is the total stock market index, and SCHG and SCHD SCHD for the other one. So let's go ahead and update the chart here. All right. So in the 10 year, you can see that you're probably going to do okay where you have SCHG kind of mid-range, and that's really supported by QQQ's strong growth. VTI is going to be your average, very similar to the S&P 500. And then again, SCHG, even on total return, is significantly underperforming. Now remember though, if you're a dividend investor, and if you're only going in on dividends like those that are in SCHD, and you are only 20 years old, just really consider that, because over the long period of time, your portfolio is, you're going to get dividends, which is great, but it's going to kind of just flatline as you see here. I mean, that's not really an exciting return, 182%, when you look at some of these growth, even when you look at the total stock market at 205% in the last 10 years. Keep in mind that when you're young, you want to kind of look at growth for the long term. Then as you get older, you start transitioning to heavier dividend stocks because you don't want the market to crash, where these big boys would crash pretty hard, kind of giving up a lot of your gains, and SCHD would maintain. That's important when you get older and you need to live off of your portfolio. When you're young, not as important. In the last year, though, it's very interesting to see that SCHG performing at 42% compared to the 26% on VTI and, of course, 12% on SCHD. So if we invested $1,000 a month into SCHD for the last 10 years, what would our portfolio look like today? Let's have a look here on the portfolio visualizer. So I'm going to do $1,000 to start off, and then we're going to do a cash flow every month of a fixed amount of $1,000. Right down here at the asset, I'm going to type in SCHG, and let's see how we make out. You can see right here at the bottom, okay, look at that. Your $1,000 invested every month grows to a portfolio balance of $407,000. Now we can do a quick calculation here if you just want to see how that looks. If you do $1,000 a month is $12,000 a year times 10 years, you're putting in about $120,000. What a significant amount of growth. So $407,000. Don't we wish we would do this? And if you did, you're sitting here looking very sweet with a $400,000 portfolio. just simply for maybe giving up a very expensive car payment and instead going in on SCHG. If we look at the annual returns here, looking very, very sweet all throughout. Even, of course, 2022, which was a terrible year for the stock market, it did drop quite a bit, but then recovered beautifully here in 2023 and still looking good so far in 2024. That's kind of exciting. Really paves your path to financial independence, does it not? Are you ready for financial independence? Well, if you are, you got to make sure you check out this video next, and we'll see you on the next video.